in motion. It's our pleasure to be here today. My name is Ranulph Glanville, and I'm honored to be joined by Bruce Burnett. I'm going to be talking a little bit about cattle to get us started, and then Bruce will provide an update about crops. I began working in the commodity markets in about 2003, and for cattle, I really started working on them in June of 2003. Now that may not mean much until I ask you, if you're in the cattle business, to think back to May 20th, 2003. And unfortunately, that was the start of the BSE crisis. So certainly a very interesting way to cut my teeth on the livestock business. When it comes to the cattle market, I have some factors up on the screen here. But as you see, you have some of the regular factors, supply and demand, but also a lot of other factors that come into play with the livestock, such as food security and related issues. So I will present some comments on the outlook for cattle, but please keep in mind, we are always one tariff tweet, one border issue, one disease issue away from a change of plans. In terms of the main factors currently affecting the cattle market, things like the Canadian dollar and its level against the US dollar and the availability of cheap and plentiful feed play in a big way. But do note that when it comes to the beef market, demand is relatively inelastic. That means that as beef prices rise, the willingness of consumers to consume less beef is relatively low. So what we see today are high beef prices, but continued strong demand. And one reason is the economic activity in Canada and the US remains quite strong, with consumers having lots of spending power. So a 1% increase in GDP tends to lead to a 1% increase in beef consumption. The reverse is also true, meaning when the economy weakens, beef demand drops off. On the screen, you see a graph of live cattle futures from roughly 1969 to 1983. And within this period, there are a couple of periods of expansion in the US economy. And then eventually, the US economy reaches a peak and cools off again. And this corresponds to a couple of generalized trading ranges for cattle futures. When the economy is strong and rising in terms of activity, live cattle futures tend to be strong. And when they drop off again, you see a cooler period before the next expansion. More recently, in the time frame from 2006 to 2025, we've also seen a couple of bull markets in live cattle futures, one of which peaked in 2014, and another which we're probably headed for a peak sometime in the coming year. Over those periods when cattle futures were strong, the US economy was also strong. Do note that there was a peak in live cattle futures in 2003, but unfortunately for Canadians, we were locked out because of the BSE crisis. One of the key factors in terms of what lies ahead for the live cattle futures market is the size of the US calf crop. And the US calf crop likely bottomed in 2004 and is now on its way. In the short term, the early stages of US herd expansion, meaning more beef cows are retained rather than sent to slaughter, and the early stages of beef heifer retention so that you can produce more calves, actually tend to be quite positive for the live cattle futures market because it means less beef supply. It's only later, once the initial increases in the calf numbers start to correspond to more fed cattle and therefore larger beef slaughter, that the cattle cycle tends to peak out. And the screen shows that in 2026, US beef production will remain relatively contained, likely hitting a trough in early 2026. It's only later, moving into 2027, that we'll start to see the flip side, gradually higher beef production posing a risk to beef prices. One of the key factors determining how quickly beef production rises is the availability of cheap and plentiful feed. And one of the factors that Bruce will be discussing momentarily is there is a monster U.S. corn crop on the way. All else equal, this will see more pounds packed onto the animals in U.S. feedlots. In terms of the outlook for feeder cattle futures, things remain relatively optimistic moving into the fall feeder run. That's because supplies will remain relatively constrained. It's only later, as we move into 2026, that we are likely to see a major peak in the feeder cattle futures market. So with that, I would like to hand things over to Bruce, who will talk about crops.
Hi, it's good. You got here in time to get out of the little shower that we had. If there was a theme of my crop tour in Western Canada, we need a lot more of this over the next little while. And the good news is that the forecast is calling for conditions basically similar today. Temperatures moderate and chances of rain increasing essentially all the way through the end of July and maybe even into the first weekend in August. So that's going to give us a lot better conditions for filling the crops. Last year we had a blast furnace. This year it's going to be a little bit more moderate. So that's good news. The map that you see on the chart there on the screen there, if you look at the red line or the red areas, those are areas that are less than 50% of normal precipitation for the past 30 days. Now, I made this before I went on my tour, started last week, so it's a little bit out of date because we've had a few showers across the prairies. But basically, it tells the tale of what conditions are. The southern areas and some of the northern areas are the driest in the prairies, and those are the ones that are seeing impact on the crops. You notice Manitoba and eastern Saskatchewan have significant areas of red. Those areas, the crops look pretty good in those regions still. They're living off the subsoil moisture. They again need to see some rainfall here in the next couple of weeks. I took a poll on the crop tour when I was going around. Nobody said that they had too much moisture. So I think basically that's the idea. We're going to need to see, a couple of inches of rain here through the next 3 weeks, and that'll help stabilize the crops a lot. In those red areas, though, we do have some significantly poorer crops than normal. And the area starts around Pangman, Ogama, and central Saskatchewan, and it goes all the way west to south of Lethbridge. Those areas are seeing very poor crops. We're already starting to see some baling of the Durham crops just for feed for guys who have cattle, because it's going to be a short year for their hay production. So, and pastures are becoming burnt up. So it's really something that is probably of most concern. That area really, even rains now will not help it out that much. It will help stabilize the yields, but the yields are already well below normal. So the crop most impacted is Durham. So the Durham yields are going to be down this year. I'm thinking about 2.5 bushel an acre lower than last year, possibly even more. Again, if we get some rains to help stabilize things a bit, that's fine. But a lot of the yields in that area, in those southern areas, are less than 30 bushels an acre. Most of them between 20 and 25, probably, if you're being quite frank. So that's the Durham situation. We've had strong demand for Durham, a good export program. We're going to have reasonable stocks as we go out of this marketing year in a couple of weeks. But the crop that we thought we were going to get, because we planted significantly more Durham area, is not going to be there. We're in fact going to see production drop from last year. So that's, I think, positive news in the Durham market. I could see Durham market staying flat through here into harvest and then starting to appreciate as we begin next year's export program. There are a couple of positive developments on the export program for next year. Mexico's out of the market, so they won't be coming in to suppress, provide competition to us into the Mediterranean markets. The crops in the Mediterranean basin are basically, I would say, sort of average. So we don't see a big drop off in demand because of a big crop there. We see some pretty decent demand for durum in the upcoming year. The other crop that's grown in the south quite a bit is lentils. We planted more lentils. They have survived quite well in the drought here because, again, they're lentils. So, but basically, it doesn't look like, although the crops look better, yields will probably be down. We planted more lentil area though, so our production is likely to go up a little bit on the lentil side. As you go into the more northern areas in the south and into the central areas of the prairies, conditions start to improve considerably. And so those areas that'll pick up the yields there for, let's say, lentils. So as you move north, conditions get better. As I said, there's some dry areas in the extreme north. So the northern Peace River region, parts of northern Saskatchewan, especially northeast, parts of Manitoba in the northern parts of their growing areas are quite poor right now too. So think of Western Canadian crop like an Oreo cookie. You've got two of the yucky bits, which are the biscuits on each side, and then the yummy bit in the middle. That's where the crops are this year. Okay, so basically for barley crops, mostly concentrated central and north, good yield potential, planted a little bit more area, so production is actually going to go up with barley a bit. This is the concern about the corn crop. We'll talk about that later, but that's going to have a big impact on prices for feed grains and again for barley itself. The U.S. corn crop is big. They've had some ideal growing conditions, and so if that continues, we're going to have a massive crop. My current yield forecast for U.S. corn is 189 bushels an acre average. So that puts us well over 16 billion bushels, and the potential carryout at the end of next year, well over 2.2 billion bushels, between 2 and 2.5 billion bushels. At the same time, the U.S. has been doing something called tariffs. Those have been wonderful things. All of their corn customers are getting tariffed right now. What do you think the corn tariffs are going to do to U.S. export demand for corn? There are not going to be a lot of countries going to be buying U.S. corn. That's not good news for us, because what we're going to see is the U.S. corn move up here. We're thinking, at least my projection is that harvest low and Chicago corn futures are on the December contract are going to be down at $3 a bushel, between $3 and $3.25, somewhere in there. And that's a harvest low. I think we probably trade a little bit higher than that, but it means we're going to have to drop like $1 a bushel from current levels between now and harvest. That's not good news for the markets. It's not good news for grain markets in particular. And it's certainly not good news for barley. For spring wheat, we have decent yields. I'm projecting yields similar to be last year. We've got a little bit more variable crop than we had last year, but we know we're not going to get the blast furnace over the next 2 weeks, because we're going to get weather like this, because that's my forecast right now. But basically, yeah, it looks fairly positive. Moderate temperatures from rain, that'll help with the fill on the spring wheat. So we should be able to get back to last year's yields. Last year's yields were close to average. They look pretty good in comparison to other crops. So we did plant less spring wheat area, so we've actually going to have lower supplies of spring wheat. At the same time, we've had record export program other than durum. So we set a record last year. This year we're 1 million tons ahead on the program, with 3 weeks left in the marketing year essentially. So we're going to hit another record wheat export program. There's no problem with wheat demand, but again, the big hammer of the U.S. corn crop is going to keep the contracts from rallying a lot. If we get some help, drought in Australia gets to be worse than it is right now, especially in Western Australia, you'd be looking at production levels that are 5 to 7 million tons less than last year. And if we could cook up a little drought in Argentina, then we might see a tail end rally. But other than that, the big hammer of U.S. corn is probably going to keep wheat prices from rallying too much higher from current levels. So I'm looking for a flat market for wheat, maybe downwards a little bit as the U.S. corn crop has its impact, and then probably rallying a bit as U.S. corn eventually starts to get back to reasonable levels. The problem with that is that it will take likely 2 years to get U.S. corn stocks right-sided again after this, especially if countries stop buying a lot of U.S. corn. Brazil's had a record corn crop this year. Brazil doesn't put tariffs on people, so they're probably going to get some of the U.S. markets that we see out there now. So that turns to canola. I don't know if you realize it, but canola is probably the riskiest crop that you grow now. It's because of that big, beautiful word, tariffs. And so we're seeing extreme volatility in the market. Canola and the vegetable oil markets itself, we're actually quite positive on. Soybean oil is trading at about 55 cents a pound right now, a little bit above. I don't know what it finished off today, but that's a good price. That indicates to me that we should trade canola at least $700 to $750 a ton throughout this marketing year so far, at least anyway, in the coming months. We're currently below that. We got a nice rally today, $20 or so. But again, we're undervalued on canola right now. We should see higher prices. The biggest problem that we have is tariffs. The Chinese have tariffs on meal and oil, and they're investigating seed for anti-dumping duties. Anyway, my feeling is Chinese will not put on the tariffs on Canadian seed. And that's good news because they bought over 40% of our crop last year on the export side. So that's on our exports. So that's, I think, positive news. I'm thinking that that's not going to happen, but I don't have a direct line to Beijing. I do not know this. And so if it was to happen, boom, you'd see the price crash much like we saw in February, where we lost about $100+ a ton in about matter of a couple of weeks. The other tariff to be concerned about is the Orange Man south of the border. And that, yep, and that's, yeah. And that possibility is that there would be a tariff on Canadian canola oil as well as canola meal. They're our largest customer for those two products. So if that was to happen, then certainly that would hurt the crushers. Crusher margins would go down. Their bids would drop in the market. You'd see an overall drop in Canadian crush over the rest of the year as long as that continued. Again, I'm optimistic. I don't think this is going to happen. I think ag's going to remain relatively tariff-free, but I don't have a direct line to the White House either. So funny they don't answer my calls. So what that means is you're one tweet away from seeing a drop like that, $100 a ton in a few weeks hanging over you. A lot of farmers have asked the question in previous sessions, well, if we got rid of the tariff threat, what would that mean? It would mean to me that we'd probably trade $725 to $775 with the possibility of trading as high as $800 next year. But again, is that going to happen? I think we're going to have this tariff threat for probably at least the first quarter to the first half of the marketing year, best case scenario. It just seems like both the U.S. and China like to hold it over top of us, and that impacts our markets. So just a quick word on the pulse crops, and especially field peas. We talked a little bit about lentils, but the field peas look pretty good. Again, they're more in the central areas of the prairies. The fields I toured looked excellent in terms of yield potential. So we think that field pea production is going to go up probably between bushel and a half to 2 bushels an acre from last year. Add into that, we planted more area. So we're going to have a pretty large pea crop this year. The one tariff that we know for sure that's happened is the tariff on Canadian peas to China. China, if you didn't know, is our largest customer for peas. So we're looking at a bigger crop with our largest customer not buying. So prices are going to probably be the same as for the grains, flat to down on the peas. Even if we solve the tariff issues, one of the concerns is that protein meals, vegetable protein meals, are being priced very low right now. Soybean meal is at multi-year lows, and again, that's a direct competitor with Canadian field peas. So even if we were to see the tariffs bump off, we would not see a huge recovery in the pea market. So again, pricing action for peas probably flat to down over the marketing year, because we just have probably too many around as long as that tariff remains in place. So that's cheery news, I know, but it's not all doom and gloom. We did get some rain here. This is the kind of weather we're going to get for the next couple of weeks. So let's celebrate that. Hopefully we get these tariff issues behind us and we get back to a more normalized trade as we go forward. And with that, thank you. I hope everybody's finished their beer. And it looks like the rain is almost stopped here. So perfect timing, I think. Anyway, if there's any questions, ask and see what